Good morning, SK, from South Africa, apparently. Good to have you with us. Well, good morning, ladies and gentlemen, and welcome to today's IFRS webinar for the members of Creston International. As usual, at this end of things, it's me, Ian, and so far all of you have successfully activated your sound. So as I can see, yes. So we don't need the sort of how to fix your sound slide any longer. The usual rules of interaction apply. In theory, but probably not in practice, you can press a little hand button which makes an alert at my end. You can then post a Q&A, and in theory, you can also ask me to activate your microphone, if you've got a microphone. You will have all discovered that on logging in, your microphone was muted. That was me. I do that sort of thing. It's because we've discovered in the last 5 years or so doing these webinars that if we have the two-way voice over internet protocol activated, it tends to reduce the bandwidth for everybody, and we get a poor broadcast. So the neatest way, as many of you have already done, to stay in touch is to use the little chat facility. It's the webinar equivalent of text messaging, and it works brilliantly. Or alternatively, you can press the Q&A button and write a question to me that way. I've got both of them open, so I can respond to either type of question. The only thing is that I believe in the Q&A box, there is a character limit, which is probably more of a problem for me in a response than it might be for you to write your question. So the chat box seems to work extremely well for staying in touch. We've got 6 multiple choice poll questions today to explore your understanding of the subject area, and I would encourage you to respond to those. Typically, when I post a question, I give you perhaps 2.5 to 3 minutes or so to think about it and make a response. Some of today's questions will be a little quicker, perhaps, in terms of your response. And of course, I'm always delighted to hear from anybody by email after the event, and there's my email address. So at this instant, we've got online Christina, Yelena, Stephanie, Joe from the London office, Kirsty, Tanya also from the London office, SK from South Africa, Derek from as far away as Jakarta in Indonesia. Welcome, Derek. Andrew Collier from the London office, Kamal, who I think I've met before, and Ben. Now, Ben seems to be struggling to get his sound activated. Welcome, Ben, who's now got his sound activated. Ben usually logs in from Australia, Perth, if I remember correctly, but it might be the other side. Good morning, Ben. Welcome. So the subject matter for the day is IAS 7, the fairly old standard now on the statement of cash flows. It's a standard that has been tweaked and adjusted a few times over its life. It had a substantial rewrite in 1997. But in particular, there is an amendment that takes effect for the current year. Now, those of you who are regulars to our IFRS webinars, I will have covered this point in the update module towards the end of last year, but not all of you were with me on that occasion. So we'll be looking at 2 or 3 slides that set out the amendment to improve disclosure about financing activity. And that's an amendment that became mandatory for the year that we're currently in. And so needs to be built into your planning for the review of the statement of cash flows. And we'll cover that during the course of the morning. So IAS 7 statement of cash flows. Now, the standard requires a cash flow statement for all companies. I make that point particularly because in some jurisdictions, for example, here in the UK, it is the case that if you are a 100% owned subsidiary of a parent, provided the parent produces a cash flow statement, then the subsidiary is exempt to that requirement, but not in terms of IAS 7. There are no exemptions from the need to produce a cash flow statement. The cash flow statement in IAS 7 reconciles the movement in cash and near cash. One of the challenging aspects, in fact, of IAS 7 is the exact definition and nature of what we mean by cash equivalents. And in my travels over the years, I've discovered it's not always accurately understood, and you'll see why a little later. So the statement reconciles the movement in cash and near cash. There's no mandatory format. There is an illustrative format included in IAS 7. And, of course, around the world as a whole, many of the networks of firms use a sort of a good group type document to illustrate a typical set of formats for the primary financial statements. Cash flows are analyzed across 3 headings. So there is the heading operating activities, which will give rise to the net cash flow from operations. Usually there's a little subline after that for interest payments and possibly tax as well. We'll come to whether it would be shown there or distributed somewhere else. Then we get the section dealing with investing, and that's primarily buying and selling kit, buildings, machinery, equipment, and potentially buying and selling subsidiaries or associates. And then financing activities, and that's the raising of capital by debt or equity or the repayment of capital. Generally speaking, cash flow reporting is gross. In other words, you don't net off ins and outs. But one fairly obvious exception to that is if you were to find yourself doing a cash flow statement for a financial institution, say some sort of investment fund or a bank, for example, where if you think of a single customer might start the year with $1 million invested. They put in 10, they take out 9, they've got 2 at the end of the year. But the point is that the ins and outs are entirely under the discretion of a customer. The fact that the customer has put in 10 and taken out 9 is reported as a net 1. And so for a financial institution, cash flow movements are netted off ins and outs when they are under the direction and discretion of the customer. There is a choice of presentation method for cash flow arising from operating activities. And I'm sure many of you will be aware that the choice is available. It's quite clear when you look at the background to this standard and indeed other similar cash flow standards around the world. It's quite clear that in fact the standard setters would in many ways prefer the direct method to be used. We'll explain them both in a few moments, but of course the truth is that actually very, very few companies use the direct method. The indirect method is, of course, where you start with a profit figure and then adjust the profit figure for the accruals, things like depreciation, profits on disposal, and in particular, changes in net working capital. It is clear that the direct method, in a sense, is preferred, but hardly ever adopted. Here in the UK, a recent study of the FTSE 100 showed that, if I remember correctly, it was 97 companies used the indirect method, and just 3 out of the top 100 used the direct method. Finally, it is the case that there will be certain transactions, especially, for example, associated with tax, where a tax payment might be considered as partly a payment of tax arising from operations, partly tax or tax recovery arising from investing, and tax or tax recovery arising from financing. And the standard has very little detail on how you might set out to share out a category of cash flow into the various categories of cash flow. So, the standard applies to all entities. And the standard provides the reasoning why that's the case. And it is, of course, that cash flow information is considered to be valuable to all users. First of all, in understanding how last year's balance sheet has become this year's balance sheet, changes in the financial position. Cash flow information is particularly important when trying to identify whether an entity is able to generate money from its activities. There's a performance metric that is increasingly being focused on, and it is, of course, the comparison of operating profit to operating cash flow. I mean, if you take a 100-year horizon time period for a company, then operating profits compared to operating cash flow should be the same amount, because over a long enough period, every customer has either paid or been written off, every supplier has been paid, every piece of equipment has been bought, used, depreciated, sold, replaced, bought, used, repeat, and so on and so on. If you take a long enough time period, cash flow from operations will be all but precisely equal to operating profit. But when you take a single year from within that time period, then the sign of a well-managed cash liquidity operation is one where the cash flow from operations is at least a little bigger than the reported operating profit. I mean, for no other reason than operating profit would be adjusted by adding back depreciation to approach cash flow from operations. So if you take a single year in isolation, the sign of a reasonably well-managed cash flow position is where cash flow from operations divided by operating profit is at least more than 1. 1.2, 1.3, that sort of scale. Now, obviously, in any one single year, a company may have a disastrous cash flow position. They perhaps overestimated the likelihood of an increasing demand. They built up stock levels, inventory to more than perhaps was really needed. And obviously, in that one circumstance, you'll get a cash flow from operations that is lower than the operating profit. But hopefully that doesn't happen more than just once or twice in a period of time. Over 100 years, they would be equal. In any one single year, one would hope that the ability to generate cash or cash equivalents means that the cash flow from operations is greater than the operating profit. Now, equally, put it the other way around, if I see a company with a pattern where the operating profit seems to be more than the cash flow from operations, my immediate concern is that there is some massaging going on in calculating profit, that they are reporting a profit but not actually able to generate cash flow from it. And I'm immediately fairly suspicious of, well, perhaps some of the accounting policies that they're adopting. Cash flow information is also very useful for modeling, particularly for cash flow forecasting as a basis perhaps for a valuation exercise. Some of you will be familiar with the idea of using a free cash flow. Although there's many different ways of defining free cash flow, but the idea of using a free cash flow projected for a period and then discounted to make an estimation of the value, the fair value of particularly an unquoted investment. And that, of course, is something that you'll be doing more of from next year onwards, because IFRS 9, the new financial instrument standard, mandatory from next year, no longer allows you the default position of measuring shares in private companies, equity investments, at original cost. Everything will have to be fair valued, and for that you may well have access to cash flow information to do a modeling exercise. Finally, of course, cash flow does not get manipulated or adjusted by reason of choice of accounting policy. As cash flow information is useful in order to compare one period to another, in order to compare a given entity to others in the sector. It aids comparability because it puts aside the somewhat subjective choices that can be made for accounting policies. So the standard requires a reconciliation of the opening cash and cash equivalent with the closing cash and cash equivalents. So what do we understand by cash equivalents? Cash equivalents are balances held in a bank account, basically, or something one would describe very similarly to a bank account. Cash equivalents are held for the purpose of short-term cash requirements, rather than being the result of an investment or other medium to long-term decision. So it follows, therefore, that when the standard defines a cash equivalent, short-term, highly liquid, readily convertible, minimum value exposure, it follows that it must have had upon acquisition and have at your year end a pretty short maturity. Okay, let's get this clear. There's a lot of people who will say that if you buy an investment that's got an 18-month life, it's clearly not a cash equivalent at the moment, but by next year's closing balance sheet, when it might have just 3 or 4, it's become a cash equivalent. Absolute rubbish. A cash equivalent is, from day 1 of its life through to the end of its life, typically no more than 2 or 3 months, always something that is available for the meeting of short-term cash commitments. So if you've invested in something with an 18-month life, it is not available for short-term cash commitments until you're at the end of its life. It never was a cash equivalent, and it doesn't suddenly morph into a cash equivalent just because it's in the last 2 or 3 months of a 24-month life. So they are, throughout the whole of their holding period, an instrument with a short-term maturity. Normally, therefore, taken to mean around about 3 months from the date that you acquired it. Now, also, of course, fundamental to the opening sentence, they're held for short-term cash commitments. It must be the case, therefore, that these cash equivalent balances must be readily convertible, they have a high level of liquidity, and they have to be convertible with minimal value change. Otherwise, again, if you're holding something that has a value change, it may not be sufficient tomorrow to meet that short-term cash commitment. So cash equivalents from day one of their existence will have a short maturity. Now, I find that that is not accurately understood in my travels around the world. 3 months, or maybe 2, maybe 4, but around that sort of length, 3 months or so from the date that they were acquired, not 3 months remaining at the end of a year. So cash equivalents certainly cannot include equities. Equities are not subject of insignificant risk, and indeed an equity, unless it's a so-called alpha share that's traded by every market maker, may not even have the characteristic of immediate liquidity. So cash equivalents do not include equities. So what do they include? Well, they include simple 3-month term bank deposit accounts, say. Or it could be, say, some government stock with a 3-month period remaining. A 90-day or shorter treasury bill, for example, would fit the definition of a cash equivalent. Overnight money market deposits. It could also be the case that cash equivalence is defined to include a negative cash equivalent, the bank overdraft. Now, classically, bank borrowings are often considered to be part of the financing activity because typically a bank borrowing is going to be for at least a year, if not 2 or 4 or 5 or whatever. But a bank overdraft is usually instantly repayable on demand by the bank. And for many companies, the bank overdraft is a part of the day-to-day 24/7 cash management process. In other words, an integral part of the arrangement is that the bank balance at any instant could be positive, could be negative, positive, negative. It's fluctuating continuously. So a bank overdraft that exists at the 31st of December, it may well have been a positive figure the day before, and it may be positive a day or 2 later. It just happens to be that it's a bank overdraft at the year end. So the existence of bank overdrafts requires a little bit of analysis and a judgment. Whether or not a bank overdraft is part of the day-to-day cash management activity, and therefore a bank overdraft is a negative cash equivalent. I've just looked at my camera image, and because I've got where my study faces, I've got the sun streaming in through my Venetian blind here, and I look like I'm behind jail. I promise you, I am not broadcasting to you from a prison. I have spent time in a prison. I was put in a holding jail in Vladivostok in far eastern Russia many, many years ago when I arrived by plane, and they didn't like the look of my visa. They thought it had been adjusted by me, which it hadn't. It had been manually adjusted by the embassy, but they didn't like it, and they put me in a visa holding jail. I promise you, despite what my face looks like, I'm not wearing some sort of ninja mask, and I'm not behind bars in a jail. So, a bank overdraft is typically to be considered part of cash and cash equivalents. Now, it follows that a cash flow within the definition of cash and cash equivalents, so a cash flow out of the general day-to-day bank account into a 30-day deposit account, and equally at the end of 30 days, back from the deposit account into the general bank account, cash flows exclude movements between the items that make up cash and cash equivalents. So those sort of movements, which of course we would associate with treasury type activity, are not apparent from an IAS 7 statement of cash flows. And that's kind of interesting because it is the case that sometime in the next 2 years or so, the IASB are planning to reopen IAS 7, and in particular, one of their early inclinations is to at least add one more category to our 3 cash flow categories that we have at the moment, and that will be for management of working capital, management of treasury activity. And it would be therefore the case that cash flows between cash and cash equivalent would appear within that treasury function, in which case then the cash flow statement becomes a reconciliation simply of opening and closing cash, straight cash. So at the moment there is a deficiency, perhaps we would say, with the IAS 7 cash flow statement, no indication given of treasury activity. Now, you all know, many of you who've been with me before, that this light blue screen means that there's a question for you. So, an entity applies IFRSs, and in its statement of financial position at the 31st December, whatever, it has cash and cash equivalents of 3.2 million. Okay, so that's the positive figure, cash and cash equivalents, a current asset. However, the figure for cash and cash equivalents at the year end, at the bottom of the cash flow statement, shows 3 million. Your conclusion is there must be an error, or it's quite common, and that's the end of it, you don't do anything special, or this can happen. But paragraph 44 requires a reconciliation to be presented. And you will see, ladies and gentlemen, that I have opened a polling panel on your desktop for you to respond to that question. Well, we've got 10 out of 14 of you have responded. And bearing in mind that there's a couple from your international department in London who are not accountants and who we would not necessarily expect to respond, I'm going to suggest that we close the poll at that point. So, 8 of you have responded with what I would describe as the right answer. Let me just save the results of that. The right answer, of course, is C. It can happen. Let's face it, Ian is probably unlikely to have invented for you the explanation that there is a paragraph 45. So you could possibly guess that C might be the right answer. But I mean, a good reason for this to happen is that the company has a bank overdraft. And so in the balance sheet under current assets, we got the positive 3.2 million. One could then imagine that in the current liabilities on the balance sheet, there's a 0.2 million bank overdraft. If the bank overdraft is, as is typically the case, gets treated as part of cash and cash equivalents, at the bottom of the cash flow statement, you would of course have a total of 3 million. So it can happen, but because it's on the face of it a little odd, that's why paragraph 45 of IAS 7 demands a reconciliation between the cash and cash equivalents that are apparent in the statement of financial position and the cash and cash equivalents that are apparent at that same date at the bottom of the cash flow statement. So well done to 8 out of 10 of you who got that right. It therefore follows that my next question you can probably now answer pretty quickly. Okay. Is the closing balance of cash and cash equivalents in a cash flow statement the same as the balance of cash and cash equivalents in the balance sheet? A, always, or B, no, not necessarily. Simple question demonstrating an instant learning point has been achieved. Good. Hit that submit button, whoever you are. Thank you. Good. As I would have hoped and expected, we've got a 100% correct response to that question. So the learning point is, just because there's apparently a different number at the bottom of the cash flow statement compared to cash and cash equivalents in the balance sheet does not immediately mean there is an error. There could be, but it's not necessarily the case that there is an error. It can happen. It will happen, for example, with bank overdrafts. It can also happen with, for example, restricted cash balances. Cash, for example, in an escrow account, where a company has deposited cash as a sign of good faith for, say, a supplier. So, no, not necessarily. Well done. Okay, so statement of cash in and cash out that reconciles the opening and closing cash and cash equivalents under the 3 headings of cash derived from operations, cash derived from, or more typically used in, investing. And it could be either way, cash derived from new debt, equity raised, or equally cash used in the repayment of debt or equity financing activities. So the statement is structured something like this. At the top, typically with then cross-references to notes to show the calculation of, for example, operating cash flow. So that top line, a key indicator of the ability of the entity to generate money from its activity to meet its needs. And then a second line, cash either from or used in investing activities. So this is money spent or equally received if you sell a surplus asset. Cash used in building capacity in order, one would hope, to generate positive cash flows for the future. And then cash arising from financing, useful in scheduling and identifying the future claims that will be made by providers of capital against the cash flow of the entity. Subtotal to net cash in or out, as the case may be, and then simply opening balance, closing balance. So, first of all, we'll focus on the derivation of cash flows from operations. Cash flows from operations are a key indicator of the ability of an entity to create positive cash out of its selling, its producing, its manufacturing, its distributing, and so on. And clearly, if an entity is going to have a reasonable chance of survival, then cash flow from operating needs to be positive. And as I hinted in my introduction, by comparing cash flow from operations to operating profit, one would hope in any one single year that cash flow from operations are at least equal, if not slightly higher, maybe 1.2, 1.3, 20, 30% better than the operating profit. Obviously, though, a single period at random may be a period when the company invested excessively in inventory, or perhaps they had to finance a long-term receivable, perhaps from an export or something. So operating cash flows derive from your principal revenue-producing activities. Buying raw materials, processing, manufacturing, creating product, storing it, promoting it, finding a customer, delivering it to the customer, collecting the cash. So the idea of a cash flow from operations is to match the cash flow impact with the operating profit, the process of determining profit or loss, using, of course, an accruals concept. So cash flows from the manufacture, acquisition, rental, and subsequent sale of assets. For example, a car leasing business, car rental business, they shall be classified as operating, even though the vehicles are likely to be recorded as items of property, plant, and equipment. If your business is to acquire and then put out on rental and then eventually replace and so on, rental, so car rental activity classically, that is classified as an operating cash flow. That was a clarification that was made to IAS 7 back in about 2008, 2009. So there are two ways of presenting cash flow from operations. The direct method, and what you have here are lines that describe the major classes gross of cash receipts and cash payments. So you have a line that says cash received from customers. A line that would say cash paid to suppliers, cash paid to manufacturing employees. The indirect method, however, is the one that is far more common. And what this does, of course, is to take the accruals-based profit or loss and then adjust it for non-cash transactions, depreciation particularly, and deferral or accrual of future operating cash flows. That's, of course, associated with selling goods on credit and managing them, the trade debtors, trade creditors, and items of income and expense that are nothing to do with operations, but they are items of investing or financing cash flow. And there's no question that the standard setters globally, I think this is the case, always wanted entities to use the direct method of building the operating cash flow. Very, very few do. So in a little pro forma, the most common method is the indirect method, which will typically be computed by starting from a profit before tax. Again, I'll just put in some illustrative figures here. Adjust for depreciation and amortization. Okay, that's a non-cash movement. Typically, because profit before tax is what you started with, that'll be after interest, so you'll add back any interest charges. That's because later we need the interest paid. Profits or losses on disposal of non-current assets are, of course, just a bookkeeping figure. And that will enable us to subtotal to cash flow before working capital adjustments. And then the working capital adjustments will be for the change in increase, decrease. In trade receivables, in my example here, let's say that trade receivables have gone up. That means you haven't had the money. That means relative to a profit figure that an increase in trade receivables would be bad news to our cash flow statement. I'm going to have a decrease in inventories. That's good news. That means that inventory that was in the warehouse last year, some of it is not now in the warehouse. That's good news. That means that there was a positive impact to cash flow from that. And in this illustration, I'm going to have an increase in trade payables. That means you've had goods delivered, not yet paid for. That's positive to cash flow. Cash generated from operations, 98,800 in these illustrative figures. I'm then going to rework these figures in a while using the direct method to get to the same results. Typically, at that point, presenters will have two lines. The standard allows them to be put in a variety of places. One line for tax paid and one line for interest actually paid. Interest paid could alternatively be put in the financing cash flow section. Taxation, well, as we'll see, the standards suggest it could be spread across all of the headings, giving us a net cash inflow from operations. And that would be a starting point, following various different definitions of free cash flow. That would be a starting point for a free cash flow analysis. Free in the sense that this is the cash flow that's been generated by operations, less your obligation to pay the tax authorities and your lenders. The only other thing that you would then look at in getting to an estimate of free cash flow is your obligatory replacement of machinery, equipment, and so on. And so a free cash flow is often defined as the net cash flow from operations less the necessary replacement spending on property, plant, and equipment. That's not the only type of definition of free cash flow. So in my illustration here, or to take a different illustration, suppose we've got profit before tax of 16,000, and we've got depreciation of 15. We've also got a gain on the disposal of some non-current assets, 5,000. And we've got working capital adjustments, opening and closing for receivables, inventory, and payables. So hopefully, ladies and gentlemen, if you've been able to print out from your PDF the slides for today, you'll be able to print that out, and you can then compare it to a solution doing the indirect method for those numbers. The profit before tax was 16. Add back depreciation of 15. Now, we had, if you look back to it, a so-called profit on disposal. Now, a profit on disposal could also be called over depreciation in prior years. It works the opposite way to a depreciation expense. So if depreciation is added back, then a gain on disposal will be subtracted. And then we've got various working capital movements in receivables. Receivables went down. Brilliant news for cash flow. 6 compared to 9. Inventory went up. Not so good for cash flow. And trade payables went up. And so we've got cash generated from operations of 29,500. A fairly healthy situation by comparison, perhaps, to what we might call an operating profit level. Now, using the same figures for a direct method, same figures as we used earlier on, we could have, and you'll hopefully see that it comes to, yes, the same total, 98,800, and then after tax and after interest, 75,300. From the movement in receivables, opening, closing, and sales, the balancing figure, well, and bad debts, obviously, the balancing figure could be 348,800, cash received from customers. Cash payments to suppliers, again, from a combination of the opening and closing creditor and the amount of purchases, we should be able to find out what was paid to, and for employees, and then for overheads and other expenses. And 98,800 is precisely the same as we had in our subtotal on the indirect method illustration for that same set of circumstances. Now, those figures are gross receipts from customers, payments to suppliers, and so on. Those are pieces of information that are not apparent from the balance sheet and the income statement. And that's why the standard setters like to encourage the use of the direct method. It actually presents numbers that would not be apparent otherwise. So why doesn't anybody, or very few people, use the direct method? Well, of course, the problem is that our bookkeeping systems do not, over the course of a 12-month period, tend to accumulate, for example, the total cash received from customers. Most bookkeeping systems will strike balances at the end of each month from the combination of invoices that month, cash received from customers, and maybe some bad debt write-offs. Very few bookkeeping systems will accumulate, for example, the total cash paid to suppliers in this example, 70,000. And so for that reason, there are considered to be systems implications of using a direct method of cash flow statement presentation. And very few bookkeeping systems will routinely accumulate, for example, that figure of $348,000, the total cash received from customers during a 12-month period. So most companies find it easier, therefore, to use the indirect method. Moving on to the next category of cash flows from investing activities. These will represent cash flows for typically the purchase of buildings, machinery, equipment, and so on. The acquisition of resources that are expected to generate future cash flows. So it gives us, therefore, an indication of the long-term investing profile of the entity. Only expenditure that gives rise to the recognition of an asset are eligible for classification as investing. So if you have a client that is heavily involved in R&D, research and development, only the expenditure on D, development, that meets the IAS 38 criteria for recognition as an intangible asset, only the expenditure on the development could be a candidate for including in this category. Expenditure on the research, or equally development that does not yet meet all 6 of the criteria of IAS 38, would not be eligible for describing as investing activities. Now that, again, was an amendment that was made to IAS 7 around about 2007, if I remember correctly. Recent debate at the IASB has suggested that, in fact, they might change back to the original understanding, which was that it was what, from a management perspective, could be described as investing. And that's kind of important because development projects that don't meet all 6 criteria and therefore can't be recognized as an asset are nevertheless very much an investing activity. And some would say, certainly friends of mine in the scientific world, would say that research is absolutely an investing activity. I mean, try telling somebody at GlaxoSmithKline that their research is not an investing activity, and they'll kick you out the building. There's no question that they see research as very much the building of resource, know-how, and hopefully, eventually, a new product that's going to generate amazing future resources. So there is a thought being debated at the IASB that they might, in fact, relax this requirement. So we're going to have the major classes in and out gross of the cash payments arising from investing. Purchase of machinery, equipment, buildings. Remember, excluding the purchase of cars, for example, that are used by a car rental business, and the proceeds from the sale of property, plant and equipment and other long-term assets. Also included in investing will be the purchase and the sale of businesses. So purchase of subsidiaries, purchase of an interest in a joint arrangement, purchase of an associate, or the sale of any of those things. And then we have the category cash flows from financing. And this is where we're going to get the cash flows in and out in respect of primarily debt and equity. Financing activities. Debt and equity, of course, being providers of capital who will have a claim on the free cash flow of the company. And so this will include, therefore, things like proceeds from the issue of shares, proceeds from the issue of bonds, mortgages raised, repayment or redemption of shares or bonds. So let's have a little series of questions. Under which classification in the statement of cash flows would you put expenditure on the development of a new product or process correctly capitalized as an intangible asset under the requirements of IAS 38? Good. 10 of you have now responded. 11. Fantastic. 100% correct responses so far. Okay, and 1, I'm sorry, whoever you are, incorrect. Okay, it follows from our discussion earlier on. I'm going to close the poll at that point. It follows from our discussion earlier on that if something is correctly recognized as an asset, capitalized therefore, then it is investing. Equally, of course, I can have another question with the opposite situation: expenditure on a product or a process that is not capitalized under IAS 38, it's not recorded as an asset. That would be an example of operating. One of you felt that it would be an operating cash flow. If it's correctly recognized as an asset, it's investing. Now, what about the second question here? Under which classification in the statement of cash flows would you put interest paid? Okay, now this is interesting. We've got 3 of you who have put it under operating, and 7 of you who have put it under financing. And of course, interestingly, you are all of you correct, because the standard gives you a choice. You can show interest paid immediately after the subtotal of cash flow from operations, and I showed it to you in a pro forma earlier, where we subtotaled to cash flow from operations, then we had a line for tax and a line for interest to give us a subtotal net cash flow from operations. So you could include the interest payment under operating, But I also showed you on that pro forma in a bracket could also be in financing. And it's perhaps the most common presentation of interest payments is to put interest payments, in fact, within financing. And I mean, the standard specifically says it could be in either. And we're not in a position today to criticize the standard, but I will do, because I think including interest payment in financing is fundamentally wrong. Interest payments are about the servicing of finance. They're not the finance, they're the servicing of finance. So one or two of you, if you've ever seen the previous UK version of a statement of cash flows, would realize that we have a separate little category called servicing of finance. And that's where we would show the interest payment and also dividend, because interest and dividend are the servicing of finance. They're not the finance itself. So I think it's fundamentally wrong, personally, to include interest payment as financing. But the standard says it can go there, or it can go just under operating in the way that I showed you earlier on. Both of those are right. Final question for you. Under which classification in the statement of cash flows would you put cash received from a factor, okay, debt factoring, under the terms of a with recourse factoring agreement? So this is where the debt factor will pay you up front the results of your confirmed invoices, but if you have a customer who then doesn't pay them, they just take it back out of your bank account. It's with recourse. Under which classification would you put the cash received from a factoring with recourse factoring agreement? And you'll see that I have opened your polling panel for that question. Now, this is much more difficult, much more difficult. Okay, so it is apparent that this has stopped and made some of you just think for a moment and take stock, which is exactly what I intended. We've now got 10 of you who have responded, so I'm going to close the poll at that point and record the results of that. And then I'm going to explain to you the thinking. 3 of you felt it was operating, and 7 of you felt that it was financing. If it was cash flows under a non-recourse factoring arrangement, in other words, where you sold your debtors, you've got the cash now, and even if the customers default, your factoring company can't take it back, that is definitely a financing arrangement. Okay, if you sold your receivables in a non-recourse, where the factor can't come back knocking on your door because a customer has defaulted. But if you've sold your receivables under a with recourse factoring agreement, that means that you're going to be suffering about debts. So you've not sold them in their entire risk and reward context. All that's happened in a with recourse arrangement is that you have perhaps generated a little bit of a timing benefit by having a factor, and in particular, you've managed to avoid running or managing a receivables and debtor collection process. It's now up to the factor. You see, if you receive your cash flows from a debtor in a normal course of events, and equally, if you don't receive your cash flow because he's a bad debtor, that's operations. If you receive cash flows from the factor in a with recourse situation, it's fundamentally no different to simply receiving or not the cash flows from your customers. So the analysis, this is something that the standard doesn't mention at all. This is something that I've come across in my travels over the years and have thought through, and I'm not alone. Most major texts in the area of IFRS conclude that a with recourse factoring agreement is probably best described as operating. It's really no different to receiving the cash flows directly from your customers, receiving them or not receiving them because they're bad. You see, the point is that when you sell your receivables under a non-recourse factoring, you have transferred the risks and the rewards and obtained cash up front. That is genuinely a financing arrangement. And when a customer defaults, your factor can't come back knocking on your door. That's financing. You've sold the risks and the rewards attaching to receivables. But if it's with recourse, all you've really managed to do is achieve a little bit of perhaps timing advantage, a little bit of certainty of your cash flows, and you've managed to avoid the running and management of a cash collection receivables process. It's no different to having ordinary trade receivables. So well done to those of you who analysed it and decided that it was operating. I would say you are correct in that. So let's take a 5-minute break now, please. And then after the break, I've got a couple of other very simple comments from the standard, and then we'll look at the group cash flow statements. And we're well over halfway through. See you in 5 minutes. I will mute my microphone and my camera for that time. Well, ladies and gentlemen, welcome back. I hope you're suitably refreshed. As you can see, the sun is changing its angle, and I am gradually going out of the lines arising from my Venetian blind. Very funny. Good. Okay, well, let's pick up with just a couple of remaining themes from the standard, and then we'll move on to consider group cash flow statements. So I commented in my introduction on whether or not cash flows are to be presented gross or net. And we've seen that in 99% of the time, cash flows will be presented gross rather than netting them off. But a good example of when that might be of relevance to you is when you're dealing with financial institutions, for example, where cash in and out is almost entirely a reflection of what the customer is doing. Cash point machine today takes out 500, a couple of days time they put the 500 back again. There's no net effect for the organization, for the bank as a whole. And also where the cash payments and receipts are items where the turnover is quick, the amounts are large, and the maturities are short. So, for example, bond speculating, and perhaps even derivatives, advances or repayments of principal that relate to credit card customers. Financial institutions will typically find that they present their cash flows from operations, investing, and or financing on a net basis. The standard also comments on the appropriate conversion rate for foreign currency cash flows. So foreign currency cash flows and the cash flows arising from a foreign subsidiary are to be recorded in functional currency, your entity's reporting currency, by converting at the exchange rate ruling, or more typically, for reasons of practicality, an average or weighted average rate. So that makes the cash flow statement conversion consistent with the income statement, the P&L conversion, at the rate ruling or at a weighted average rate. Now, of course, there's another element to currency conversion, which is that if you've got a balance in a foreign currency bank account, say at the beginning of this year, you've got €1 million sitting in as a foreign currency balance, and at the end of the year, you've still got that same €1 million. If you're reporting in sterling, it'll be worth a little more or in fact, a little less, given the current movements. And so there will be an exchange difference arising on the cash and cash equivalent balances that are foreign currency. And they're to be shown separately. Typically, in fact, they get shown down at the bottom of the cash flow statement in the reconciliation of the opening and closing cash and cash equivalents. Interest and dividends is a particular subject area commented on in the standard. So cash flows, interest and dividends received and paid, so the in and the out arising from what I would call servicing of finance, shall be shown separately in the same place consistently as either operating or investing or financing. I mean, you can put it in any of those places. I personally believe that that is a deficiency of IAS 7. I prefer what we did for many years in the UK, where we had a separate little section of a cash flow statement dealing with the servicing of and receipts from finance. Interest paid is going to be disclosed as a cash flow, even if all 100% of it has been capitalized under the rules of capitalization of borrowing costs of IAS 23. Interest paid and interest and dividends received are quite commonly treated as operating cash flows for a financial institution. But there is, in fact, no consensus on where is the right place to classify them for other entities. I mean, a financial institution, interest income and interest expense, net interest margin is fundamentally the way they do business. But for other companies, I mean, is the earning of interest something that is routinely expected and planned for and controlled, and therefore you might say is operating? There is no consensus as to where such cash flows should be classified for other non-financial institutions. So, as we saw in the opening statement, cash flows from interest and dividends received and paid, shown separately in the same place, wherever you'd like, operating, investing, or financing. There's a similar circumstance that arises with tax payments. I mean, again, clearly, the cash flow statement is going to be showing the tax paid rather than the accrual figure associated with current tax and with deferred tax. But the point that's made in the standard is that tax cash flows might arise from operations, but they might also be, for example, the tax benefit of accelerated depreciation arising from investing, and they could also arise from financing type activity. So cash flows arises from taxes on income should be separately disclosed, classified as operating unless you can identify tax cash flows that relate to financing and tax cash flows that relate to investing. So I often say, well, yeah, spread it around the place. It's tax. Taxes paid are, however, usually, typically, you'll see them just after the subtotal of operating cash flow, exactly as I showed you in that pro forma earlier on, where you then say from cash flow from operations, tax paid, interest paid, and then you get that subtotal net cash flow from operations. If, however, it is practicable to identify tax cash flows with individual transactions gave rise to an investing or a financing cash flow, then you ought to stick the cash with that investing or that financing cash flow. So potentially spread it out. Now, that's all that the standard says. There's no further guidance on how you might set about divvying up the tax cash flows into operating, financing, and investing. In my experience, I've never seen it done. So I think clearly the expedient, the practicable solution is just to show it immediately after the subtotal of cash flow from operations. Now, the standard doesn't deal specifically with group cash flow statements, but it's my privilege to be able to present to you some thoughts on how we're going to set about preparing a consolidated group statement of cash flow. Now, let's get this clear, because again, I find some people try to produce a group cash flow statement by consolidating lots of separate cash flow statements. It's not the sensible way to achieve it. What you do, of course, is you prepare the consolidated balance sheet or the group balance sheet and the consolidated income statement, and then you find the balancing items between last year's balance sheet, this year's balance sheet, and the income statement, just like you would do for a single company. I have successfully done it once by separately consolidating, and it was one of the subsidiaries was foreign, so it was quite awkward, separate statements of cash flow. It's not the way to do it. Set up your consolidated primary financial statements, the balance sheet and the P&L, and then find the missing figures. And so that's very much what I'm going to do with you here, to find the missing figure in the non-controlling interest balance. So you've got an opening balance, you've got a closing balance, you've got the share of the profit after tax for the year that is disclosed in the P&L account under IAS 1, and your missing figure would be the dividend paid by a subsidiary to its non-controlling interest when that subsidiary paid a dividend. Similar, but in a reverse set of debits and credits, will be the issue for associates. Here, of course, you've got an opening asset rather than the non-controlling interest, which was an equity balance. You've got an opening asset, share of net assets of last year. You've got a closing share of net assets. You've got in the P&L account the share of the profit or loss after tax of the associate, and the balancing figure will be the dividend that's been received from the associate. And then finally, there are the cash flows associated with the buying or the disposal of subsidiaries. So taking just some illustrative figures, supposing we've got a disclosure in the profit and loss account that the non-controlling interests share of or attributable profit for the year is 1,800. That, remember, is either shown as like an expense on the face of the P&L to arrive at the profit attributable to the parent shareholders, or alternatively, it's shown as a disclosing item to the profit for the year. So that should be apparent on the face of the income statement. And then from the face of the balance sheet, we've got an opening and a closing non-controlling interest. So this is the non-controlling interest's share of net assets. It might or might not, of course, include a little slice of goodwill, depending on whether the initial measurement of NCI was at fair value or simply at share of observable net assets. Remember, IFRS 3 gives a choice of the measurement of a non-controlling interest upon the initial recognition of that NCI. So the NCI has gone from 3,400 up to 4,100 on the balance sheet for the year. That implies if their share of profit was 1,800, and yet in the balance sheet the equity has only gone up by 700, there must have been a 1,100 cash dividend paid to non-controlling interests by a subsidiary when that subsidiary declared its dividend. Now, non-controlling interest movements and the cash paid to an NCI holder are not always going to be apparent in a group balance sheet, because increasingly nowadays the non-controlling interest as an item is often zero, in the sense that many acquisitions take place where 100% of the outgoing shareholders sell their shares to the new parent. Now, similar for the associate, but of course here, the associate's share of profit in the P&L is a positive figure, if you like, rather than negative. And in the balance sheet, we've got a pair of asset figures rather than, for the non-controlling interest, a pair of credit balances, namely equity. So in the P&L of a group, let's say that we've got a share of profit of 1,000. In the balance sheet, opening and closing associate, shown as 4,400 last year, grown to 5,100 this year. So it's grown by 700. But if their share of profit, our share of profit was 1,000, but in terms of the balance sheet, it's only grown by 700, we must have received from the associate a cash dividend of 300. And it'll be the cash received from the associate that appears in the group statement of cash flows, 300. Finally, there are the many and various effects of acquisitions and disposals. Cash might be used to effect the acquisition. Cash might be received in the disposal. But not only is the basic cash paid or cash received for the deal, there will also be, typically, in a subsidiary that arrives, it brings with it a bank balance or overdraft, and equally when a subsidiary is disposed of, it takes away with it its bank balance or bank overdraft. So the cash impact of acquisition or disposal is shown as a single cash amount in the investing activities section, and it will be net of any cash that comes with a subsidiary acquired or cash that we say goodbye to when a subsidiary is sold. So the final polled question for today: under which classification in the statement of cash flows would you put the cash received on the disposal of a non-controlling interest in an investee? Under which classification in the statement of cash flows would you put the cash received on the disposal of a non-controlling interest in an investee? For example, you had, say, a 70% subsidiary, and you sold the subsidiary. You've therefore sold not only your controlling interest, but you now will de-recognize a non-controlling interest. And let's open the polling panel for you. Good. Strong response already for the right answer. Good. I'm going to suggest that we close that poll in the next 10 seconds, just in case anyone else wants to submit. 3, 2, 1. Good. Well, as I said, a nice, strong response for the right answer. The right answer, of course, is that it's an investing cash flow. You simply dispose of a non-controlling interest, a shareholding in an investee. Well done. So, occasionally, in reconciling two balance sheets, you find that there are substantial non-cash transactions, which are quite fundamental to understanding how the two balance sheets have changed, but it didn't require cash or didn't use cash. I mean, a great example, of course, is the conversion of debt to equity. Fundamentally changes the structure of the balance sheet, but there's no cash involved. Or, of course, another example is the recognition of a finance lease at the end of the year, where there's an asset recognized and a liability, but no cash involved yet. So, non-cash transactions, fairly obviously, are excluded from a cash flow statement. It's therefore the case that they are apparent or should become apparent by disclosure elsewhere in the financial statements. But in order to assist the reader in understanding how those two balance sheets reconcile, there is an important new disclosure from the 1st of January 2017. So, as I promised, we'll just pick out the bones of this new disclosure. The amendment requires a reconciliation between the opening and closing amounts for each item for which cash flows could, in perhaps a more normal transaction, or would have been classified as financing. So, movements, for example, in debt balances, movements, for example, in finance lease balances. And this should enable a reader to reconcile opening and closing debt balances in terms of how much was cash flow and how much was not the result of a cash flow. And it's a very similar requirement to what we did for many years under the old UK requirement of a so-called net debt reconciliation. In the UK, we did it as net debt, so we had debt balances minus any positive bank balance. In the international standard, it's more, I suppose, described as a gross debt reconciliation. It's mandatory for accounting periods commencing on or after the 1st of January this year. So for the first time, guys and girls, you'll be doing it at the end of this year. It's prospective in its application, so there's no requirement to restate the previous year, 2016. And we would imagine that it looks something like this. So it'll probably be described as components of financing activity, excluding equity, because the standard says this is not movements in equity. And so typical debt balances might be, say, bonds, other long-term borrowings, and a lease liability. So we've got the total debt at the beginning of the period. I say, under the old UK standard, we then used to deduct the bank balances. So it was a net debt reconciliation. This is a gross debt reconciliation. We can find in the cash flow statement that there were some long-term borrowings that were repaid, an amount, 400. And we can find from the cash flow statement that there were payments made under finance leases of 60. But when we try to look at the end of year situation, it doesn't work for both the borrowings and the lease liability. And the reason is, of course, two columns headed up, non cash changes. During the year, we made an acquisition, and that subsidiary brought with it a pile of debt, 600. So debt that appears in the closing balance, but was not in the opening balance sheet. And also during the year, new leases were entered into, an amount of 400. And in that way, then, we've managed to achieve the reconciliation of the opening and closing financing activities, excluding equity. Not a difficult disclosure, something which, with sufficient diligence, a good analyst or researcher of financial statements would actually be able to build and derive that themselves. The thought is, well, why should we expect users to make those leaps of faith? We'll simply give them this additional disclosure. So there it is, effective for this year. That'll be the first time that you present this. Now, finally, give you something to take away and think about, in early 2000 and whatever, 6, company ABC Limited entered into an operating lease with a 10-year term. And the terms and conditions of that lease require that a chunk of money, 4 years worth of rental, be put aside into a separate bank account. So the terms and conditions require that an amount equal to the rentals for 4 years, as 2.4 million, be put in a special bank account. And amounts can only be withdrawn from that bank account after those 4 years of payment of rental have expired. ABC is the owner of that bank account. I mean, you'd find this balance would get reported in your standard bank letter. So ABC is the owner, no question about it. But the balance in this account is pledged to the lessor as a sign of good faith. It's what you might call an escrow or escrow balance. It's pledged to the lessor as a sign of good faith under the terms of the lease. So my question for you to take away and think about, is this bank balance part of cash and cash equivalents? So ask yourself the question, is it, and always will it be, available for the meeting of short-term cash commitments? I hope you can probably immediately see that your analysis is likely to suggest no, it's not part of cash and cash equivalents from the perspective of the cash flow statement. So where should it appear in the balance sheet? Where should it appear in the cash flow statement? So I'd like you to take those thoughts away with you. And it's another great example of how restricted cash can make a difference between, there's a clue, it'll make a difference between the cash and cash equivalents that you get to at the bottom of the cash flow statement and the cash and cash equivalents that might be apparent from the balance sheet. Finally, the standard has a list of required disclosures, fairly predictable. Cash and cash equivalents might be more than 2 or 3 headings, and so we have to present the movements, the components. We have to describe the company's composition policy. In other words, what is it that they conclude is a cash equivalent? And by the way, has that conclusion changed during the year? A disclosure that was found to be really important in the light of the financial crisis was, are there any cash and cash equivalent balances that are not freely available for use within a group? Other disclosures, there will usually be a fairly extensive description of the assets acquired at fair value, the type of consideration, cash, shares, bonds, all associated with the acquisition and the disposal of subsidiaries. So more than just the cash, there will be a nice list of assets acquired, consideration paid, and so on. We've seen now that there is the need to present this reconciliation of the debt movements during the year. And there are 4 voluntary disclosures. Now, I don't know what your experience is of voluntary disclosures. My experience is that if it's voluntary, most people ignore it completely. But there are some useful, I believe, disclosures here. In particular, the amount of undrawn facilities. Now, typically, that disclosure is made in the light of the so-called liquidity risk disclosures that IFRS 7 demands. So, undrawn facilities are fairly commonly disclosed. IAS 7 has expected it voluntarily, admittedly, for many, many years. Interestingly, the standard has not been updated to remove the reference to proportionate consolidation. And then there is a voluntary disclosure. I've seen it once, and it was with British Airways, of the cash flow on simple replacement as opposed to expansion cash flow. If you think about it from the perspective of an airline, there's quite an important distinction that's being made between the simple replacement of old Boeing 737s. I think they've pretty much finished flying nowadays. There's quite a distinction to be made between the simple replacement of an aeroplane that's reached 20 years, typically, as opposed to expanding the fleet. And for many years, British Airways made that disclosure voluntarily. I don't know whether they still do. I haven't had the privilege of teaching British Airways now for nearly 10 years. But it's an interesting example of how a cash flow statement might actually present the information to enable a free cash flow to be identified. Free cash flow being, of course, the net cash flow from operations, so after tax and after interest, minus the committed replacement spending. You know, you're not free to decide to replace kit when it wears out, whereas you are free to decide whether to expand or not your property, plant, and equipment. So I've only come across the one organisation, British Airways, that made that distinction. There may be, some of you may know of others. And finally, one that I have never seen in the whole of my life would be segmental cash flow. I've never seen it. I suspect it's one that is universally ignored. So, to conclude our time together today, the information conveyed by a statement of cash flow does very much depend on what is treated as a cash and cash equivalent. Because if something's not a cash or cash equivalent, part of the opening and closing reconciliation, then it has to be part of either operating or investing or financing. We know that cash equivalents exclude equity investments, absolutely the case. But we also know that cash equivalents may or may not, depending on the apparent circumstance of the usage of a bank overdraft, may or may not be part of cash and cash equivalents. So there's a little bit of judgment involved there in that conclusion. Finally, of course, we know that cash flow is of critical importance to users. It's critical to the entity in terms of its survival. And so therefore the standard makes the comment that it would be justified to make cross-reference from the cash flow statement to the management commentary or director's report or MD&A, management discussion and analysis, whatever you choose to call it. Cash flow is critical. And my belief is that a proper commentary on the performance of the year would absolutely include cross-reference to aspects of cash flow. Finally, there are some voluntary disclosures. Sure, one might like to encourage the client to do that. In my experience, there is very, very patchy use of the voluntary disclosure. And so the undrawn facility disclosure, typically you will see it now in an IFRS 7 liquidity risk description, rather than as a result of IAS 7. Well, ladies and gentlemen, finishing 6 minutes ahead of schedule. That's brilliant. Thank you very much, all of you, for being with me. I'm due to see you all again just before Christmas with, I think, an IASB and IFRIC and EU and what have you update to what's been going on during the last year. So it's my opportunity to say have a great day, enjoy what you're doing, and the link to the recording will be sent out to you sometime, I guess, probably either the end of this week or early next week. Thank you very much for being with me, everybody, and have a great day. Bye-bye.